Today we are going to talk about a simple market maker method strategy called the EMA strategy. We are going to review all its parameters that are simple to understand and easy to follow. But before we jump into the whole video, be sure to check out our free signals Telegram channel. The link is right in the description box below. If you are new to this channel, hit that subscribe button and smash the notification bell icon so that you'll be notified each and every time I upload a new video. As we all know, that after a rise or a drop, the market should chop. It should also pull back. The major reason for this is that it costs money to move the market. Market makers are the guys behind the moves, and at some point they need to book their profits. When they close their large positions, either the demand or the supply of that particular currency pair surges. This leaves a trackable pattern that is easy to see to the trained eye. Mostly these surges in demand or supply results in price pulling back. 85 to 95% of the time, the market makers introduce fines again at the 200 EMA. You do not need to count levels with this strategy. This is the point where traders should start looking for opportunities, and that is exactly what I will teach you in this video. So, you are probably asking yourself which time frame to use. The easiest time frame to observe these moves is the M15 time frame. You should keep in mind the timing to look for these moves. If you haven't watched the perfect times to look for entries, check out the video on this channel where I explained the perfect times to look for entries. But actually making a recap of that video, avoid trading during session changeovers and make sure you see clear stop hands before deciding to make an entry. Strategy definition. This strategy is very simple. It uses 3 EMAs, which are 13, 50 and 200. EMA 13 is the signal indicator. Then the 50 is the peak locker and the 200 is the baseline. These are just big words for nothing, but the EMA is just that one that we use for confirmation, for entry confirmation, and the 50 and the 200 are the ones that provides a point that gives us assurance that the peak is locked, and the 200 is the baseline where we will wait for price to bounce on. So the first step is to wait for 50-200 crossover. This signifies injection of liquidity into the market by the market makers. Usually 50-200 cross on the M15 time frame occurs in the first level of the market maker cycle. So the next step is to wait for price pullback to the 200 EMA. After price is pulled back to the 200 EMA, wait for the entry trigger. And what is the entry trigger? The entry trigger is simply candle closure above or below the 13 EMA. Don't worry, we are going to give examples of what we are explaining here. So these are the trade parameters. For any trade taken with this methodology, I recommend putting 25 pips at the stop loss side and 50 pips at the take profit side. You should also not risk more than 5% of your account on one trade. I actually made a video on risk management. You can go and check it out so that this would be easier for you to calculate your risk and so forth. So let's have examples of what I am saying. this is euro against US dollar, example number 1. The first step is to see 250 and 200 EMA cross. I'll first define the colors of these EMAs. The 13 EMA is the one in red, the 50 the one in light blue, and the 200 is the one in black. So the first step is to see 50 200 cross, and mind you, all these steps are fundamental for this strategy to work. So 50 200 cross, then after that this actually shows that the market makers were in drive. They had large positions when this move was being made. Then at this point, market makers, most of them closed their positions. That is why there was surge in the power of the euro, and price started to pull back to the 200 EMA. And as I said earlier, that the market makers reintroduce funds at the 200 EMA 85 to 90% of the time. This is where they re-entered more positions, and some were actually scaling in and some were actually being introduced in the move. So after price is pulled back at the 200 EMA, we wait for entry closure below the 13 EMA. So the entry closure was made with a vector candle, but it's not advisable to enter after such a vector candle. We would wait for a pullback of price to the 50% of the vector candle that is closed below the 13 EMA. In this scenario, we had this green candle that pulled back to the 50% of the vector candle. This one will be a more sniper entry than entering after closure of this candle. So you better wait for pullback of price to the 50% and enter while that candle is still running. Then we actually had our 50 pips. So taking 25 pips from this point, our 25 pips was somewhere above this structure. Then our 50 pips was actually within this run. Then on this example, we were actually issued 2 points of entry. That on this day we had our first 50 pips and closed our trades. Then on the following day, we actually had price bouncing on 200 again, and our entry closure was actually made at this point. You might be wondering why you were not going to enter at this point. This is because this was still Asian session, and timing is very important. So our first trade, our entry point was in the London session, and when candle closed below the 13 EMA, that is when we were going to enter. Our stop loss was right above this structure, which is 25 pips, and our take profit was within this long run. So these long sustained runs of price signifies market maker drive. Then on our second example, our first step is to see 50 200 cross. Price actually pulled back to the 200 EMA, and candle closure above 13 was our entry trigger, and we had our 50 pips. Our 25 pips was actually below this structure. On the following day, we were actually issued another setup, which was also a beautiful setup, and we were going to earn some more 50 pips. Then this was a gold example. It actually occurred recently, and if you are someone who is following the social media, there are some traders that actually end over 1000 pips on this move. It was just as simple as waiting for 5200 cross, then price pulling back to the 200 EMA and candle closure below the 13 EMA, and there you have it. Your take profit was definitely going to be hit. Then this was pound against odd. The first step is to see the 5200 cross to signify our pick as locked, then wait for price to pull back to the 200 EMA, and that was the first point of entry, and candle closure above that was going to give us 50 pips. On the following day, we actually had another point of entry and earning 50 pips. On this day was actually another point of entry, meaning that within this cycle we had a total of 150 pips. I'm sure by now you can actually see that this strategy is a very simple one and not even complicated. So without discipline, you will never be consistent, and without consistency, you will never achieve the goal. So you have to stick to the rules as we discussed. Do not give yourself pressure. I know that the social media is flooded with people who are posting demo accounts, getting inexplicable amounts of money per day. Do not give yourself pressure. Stick to your rules, and consistency will be your friend. So in conclusion, follow your plan without deviation or hesitation to act. And on that note, thank you for watching this video. Like and subscribe, and check out our free signals Telegram channel. This is the link in red, and do not forget to share with someone. Today we are going to talk about a strategy that can earn you at least $1,000 every single month. This strategy will earn you big, but will shock you on how simple it is. So in this video, I'll review how you can work everything in your favor. Before we jump into the whole video, be sure to check out our free signals Telegram channel. The link is right in the description below. If you are new to this channel, hit that subscribe button and smash the notification bell icon. So first things first, patience is the first port of call in this strategy. You will need to stay composed in order to take only pristine trades that I will actually explain in this video. After taking the setups, patience will also be needed to watch them mature. So here's the strategy explanation. This strategy is a swing that can last from 2 to 7 days in trade. It looks for opportunities when position market makers reintroduce funds into the system. You may be probably wondering what all this is. Here's the explanation. Although market makers have access to large sums of capital, the figures are limited. Therefore, they will need to close off their trades and book profits. When they decide to take some position trades again, their point of entry is clear to the trained eye, and it is also our point of interest to enter the market. To simplify the point market makers' entries, we use the H4 time frame as well as a series of exponential moving averages. Here's the strategy definition. The time frame of observation is the H4 time frame. Only 3 indicators are used, and these are the 13, the 50, and the 200 EMA. The pattern to look for is strictly the multi-session W or M in the zone of interest. This multi-session W or M should be in the zone of interest. So basically, what is the multi-session W or multi-session M? It is basically an W that occurs its legs in 2 different sessions. This might be Asian, this might be London, or it might be London and the other one occurring in the US. So this is the only setup that we will be looking for, and our entry will be made after M15 closure below the 13 EMA after the second leg has been issued. So this multi-session M or multi-session W should occur in the zone of interest. To get the zone of interest, these conditions must be met. The first condition is 13 EMA and 50 EMA must have a crossover. The second condition is 50 EMA crossing 200 EMA. Then price should pull back to the 200 EMA and gets rejected. At the 200 EMA, that is our point of interest or our zone of interest, as I said earlier on. So within that zone of interest, that is where we will be looking for multi-session M or multi-session W to make our entry. Here are the strategy parameters. The stop loss for any trade taken with this strategy must be 35 to 50 pips. The take profit must be 150 to 200 pips. But if you have patience, you can actually keep a trade up to 600 or 400 pips. This means to achieve this target, you will need to wait a bit longer than these ones that I have stated. So here are the examples. This is GBP against USD, H4 time frame, and we are going to walk through the conditions that we have laid out before. The blue line or the blue EMA, the light blue EMA is the 50, the red EMA is the 13, then the cream EMA is the 200 or the off-white in color. Those are the only indicators that we'll be using. So from this point, we can see that 50 crossed, there was a crossover of 1350 here, which means our first condition was met. We had the 250 crossover here, our second condition was met. Then what we were now looking for is price to pull back to the 200 EMA and offer us our zone of interest. When price did that, at this point, that is where we were now supposed to look for a multi-session W in order to go long. Entering a trade at this point was definitely going to issue us a rise of approximately plus 650 pips in rise. So from this point, you were going to exit at your own point of choice depending on your target. But as I said, if they are pound pairs, you better take 400 pips against a stop loss of 50 pips. Another example is on USD against the Canadian dollar. Our first condition was met after the 13 and the 50 had crossed. Our second condition was met after the 50 and the 200 crossed. So our last condition was to see price coming back and gets rejected at the 200 EMA, which happened at this point. So within this point, that is where we are calling the zone of interest. Zone of interest or ZOI. In the zone of interest, we were interested in finding a multi-session M, and we were going to enter after M15 candlestick closure below the 13 EMA after the second leg was issued. I've come across several comments asking me what to do if these conditions, if any of the conditions that I have explained doesn't occur. The most correct answer is whenever any of your conditions is breached, you have to scratch that trade. Do not force yourself or confine yourself on one pair, as we have a lot of pairs within the trading industry. This is order against the dollar, H4 time frame. This one, I left it to show you how it will be happening. The first condition was 13 and 50 cross, and it was actually satisfied. The second condition was 50, 200 cross, and it was actually satisfied. So the next thing is we are now waiting for price to come back here, issue a multi-session M, and boom, we have our take profit at 200 to 300 pips depending on our choice. So this is basically that what we will be looking for. There's no drawing of levels, there's no complex things, it's just waiting for your conditions to be satisfied. And as I say always, for this to work you need to be patient enough, because if you rush the process you are definitely going to make entries where there are no setups. So likewise, after getting to know this strategy, you must go back on the charts. You have to back test and to see if you can actually see these things in hindsight. Because if you can see it in hindsight, you cannot see it in foresight. Go back, find at least 18 currency pairs. Look for these setups. Actually look for the conditions on the H4 time frame. You can even print your markups like these ones. First condition met, second condition met. Print off your markups. After printing those markups, you have to see them every day so that the setup imprints in your mind. You can use this strategy alongside other different strategies that you have. You cannot just confine yourself to one strategy, as the market needs someone who is adaptive. So without discipline, you will never be consistent. I always repeat this in all my videos. And without consistency, you will never achieve the goal. So do a lot of meditation and stick to the only trades that we've discussed. Do not give yourself pressure, as the internet is flooded with people who are trading demo accounts and who just show you or review as if trading is a get-rich-quick scheme. In conclusion, follow your plan without deviation, distracting thoughts, or hesitation to act. On that note, thank you for watching. Like and subscribe, and check out our free signals Telegram channel. This is the link in red and it is also in the description below. Are you a trader struggling with determining the trend? Are you also struggling to find the rightful supply and demand zones in the market? Is getting entries something futile? If so, this is the right video for you. Welcome to Bunnex Investment Group, and consider subscribing if you haven't done so. And don't forget to click the notification bell icon so that you'll be notified each and every time we upload a new video. On that note, let's actually jump into our today's video. So in this video, we'll go through these topics. We'll first define the 200 EMA, then define the 200 EMA strategy and give the strategy parameters, and the last but not least will be a chart example. So if you want to know how exactly you can apply the 200 EMA on the charts, as well as how to trade using the 200 EMA, make sure you stick up to the end of this video. So the 200 EMA, also known as the exponential moving average, is an indicator that tracks the 200-day price move to determine trend. It is an indicator that can help to make our decisions, since we can see where the market is actually flowing. So it's an indicator that can track 200-day price move to determine whether we are in a downward trend or we are in an upward trend. So there's a popular saying in trading that states, always trade with the trend. Make the trend your friend. So it is available on all trading platforms, usually as a built-in indicator. That is MT4, MT5, C-Trader, Ninja Trader, even the TradingView, it's available for free. So here is the 200 EMA strategy definition. Since we defined the 200 EMA as a trend setter, we will utilize this property. Actually take advantage of the property that it can show us the 200-day move trend. So whenever we see the market below the 200 EMA, it is a sign that the market is in a downward trend. And whenever we see it above, it is also a sign that it is an upward trend. So it is not wise for us to enter the market blindly or just the market impulses, but wait for the market to give us a proper pullback and the 200 EMA retest to act as our entry point. So what we mean is we need to see, let's take for instance, this is the 200 EMA. We need to see the market either going down, crossing over the 200 EMA. This will become our first sign that we are now in a downward trend. We must not enter in such an impulsive move because the market will always pull back after inducing traders. So the next thing is to see the market come back to the 200 EMA to retest that 200 EMA, and this becomes our zone of market interest. That is where we would look to get into the market for a possible continued move. So the retest can be seen on the H1 time frame. Why the H1 time frame? It's actually a time frame which is median, both short term as well as long term. So below is a chart that summarizes the above explanations. In this case, we can see this particular price move on euro against the US dollar. From this point, we can see that the market went below the 200 EMA, which was an impulsive market cross below the 200 EMA. After that, we can see a price pullback to the 200 EMA to give us a zone of market interest where we are looking to get reasons for entry within the market. So let's go ahead so that you fully comprehend and understand how to utilize this. So here's the strategy definition. These are the instructions of how to use the 200 EMA in your trading. The H1 chart must show a market crossover of the 200 EMA up or down, right? Wait for the move of at least 1 day, then a market pullback. So after the crossover, we need to see at least a day so that we won't find ourselves in market consolidations. Then the market retest on the 200 EMA will give us a zone of interest where you would expect a candlestick reversal pattern for your entry. There are several candlestick reversal patterns, bullish engulfing, bearish engulfing. It's up to you to choose which ones you focus on. So as said earlier in the video, this is now the chart example of the particular 200 EMA strategy that we have been talking about. The first thing, as we said on the chart on the slides, is to see the market shifting or crossing over the 200 EMA. In this case, we can see the market going above the 200 EMA, and this is the first sign that we are now in an upward trend. After a day with of the market crossover, we now need to see the market pulling back. To pull back, it retested on the 200 EMA and our 50 pips was actually bagged. Then it came back again, it bounced on the 200 EMA, another 50 pips was actually bagged. So this is actually what is in front of you, something that you can also apply on your charts. We can see that from this point we have the market crossover with the 200 EMA, and the market actually came back to retest the 200 EMA, and 50 pips was actually bagged at this point. Although the market went straight down to this point, probably you are going to get more than 110 pips, but we always take what we have been given. Then at this point, we can see that the market attempted to go above the 200 EMA. But as we have said that we need a day for us to actually consider it a crossover. Moreover, we need a market impulsive move, which is basically a sign of induced traders taking part within the market. So this was actually something that could not be validated. Then this one, still considering this market crossover to the downside of the 200 EMA, this was going to offer us another entry point, and the 50 pips was going to be hit. At this point, we had an impulsive market rise, right? On this impulsive market rise, we could actually say we are now above the 200 EMA. As you can see, the price was now playing above the 200 EMA and went back to the 200 EMA. However, it went down again, and this was a negative 25 pips that was going to be incurred on that particular trade. Then since the market is now below the 200 EMA, we could get this as our entry point, and 50 pips was going to be hit, another entry point, then another 50 pips in the back. Then we go down, we can see that at this point the market came back again to the 200 EMA. However, we could not reach 50 pips at this point. So whenever we reach 25 pips to 30 pips, we need to move our entries to break even so that we protect our accounts. So at break even, it actually dropped around 44 pips, and at that point we had our stop losses at break even and it was taken out. So at this point we can see that the market went above the 200 EMA. So it is the play of the market makers that at some points you'd see that they fail to come and retest the 200 EMA, and it's all good because we don't have control over the markets. We always wait for our edge to play out. At this point, the market actually came back to the 200 EMA, retest, and gave us the 50 pips. Then at that point, we can see the market went below the 200 EMA, came back to retest that 200 EMA, and our 50 pips was actually backed. So as I always say, you must not take any strategy and do it blindly on your live accounts and learn something new. You need to go back and backtest, and for this strategy to fully function and be very useful, you need to at least incorporate the concepts of levels counting, and that is what we teach in the private classes. And if you really need to understand the whole thing, make sure you check out our free Telegram channel. The link is right below, where we share free signals, support, as well as announcements for any upcoming classes. On that note, we come to the end of this video. Thank you for watching. Like and subscribe. In this video, we are going to talk about an easy setup that any trader can follow and make lots of money out of it, provided they put in the patience and discipline for that particular setup. So we'll go through everything you need to know pertaining the entry points of this golden trade setup. But before we go through, make sure you subscribe to this channel if you haven't done so, as well as checking the notification bell icon so that you won't miss any of our content as we upload. So we are going to explain this in 4 parts. We are going to start on peak formations, explain what these are and how they actually forms on the charts. Then the required EMAs. These are the basic indicators that we require for this particular golden trade setup. Then entry anticipation, the point exactly that we need to actually prepare ourselves to enter the market. This is actually one of the most important topics in this video, and you need to watch it for you to understand how to spot these golden trade setups. Then the last but not least, which is also fundamental to understanding and comprehending this whole video, is a chart example that we will do for on one chart. So the first topic, as shown on the outline, is the peak formations. And for this video, we are not going to delve deep in counting of levels, which is mostly taught on this channel. If you do not understand the concept of levels, you may check out our older videos. So basically, levels are impulsive rises or drops. Actually, they are rise on charts as surges of demand or supply of a particular currency due to the amount of contracts that would have injected by the market makers. So we trade the institutional market maker method, and you can actually go back to understand it in much detail. So with this being said, at level 3, we expect to see a market reversal, right? So if ever we have level 1, level 2, and level 3, we reach a point of reversal. And this is the point that we call a peak. So depending on the market context, a peak can either be called a PFL or peak formation low. Like in this context, we have this as the peak formation low, and if it is in a downward context, we'll actually reach a point, will actually come from a point called the peak formation high or PFH. So from these peaks, we shift away from peaks with a very fast move, indicating involvement of the market makers. So at peaks, although some traders loves to trade from the peaks, there are actually points of high risk. Why? Because the market makers have all the room to actually manipulate the markets. So I actually advise not to get your entries from these peaks, because in some cases you'd see that they issue a very beautiful reversal pattern like an M, but later they'll do like this to actually grab all your orders before they go away. So to remove that subject, risk, because I would say we are not in a 5 out of 10 business. We are in a 9 out of 10, 8 out of 10, 7 out of 10. And to remove this risk, we will actually trade away from the peaks. So our golden pattern is expected when these market makers book their initial contracts, right? So whenever they actually reach a reversal point, the PFL or PFH, they actually shift the market with very, very powerful, vehement move, and then later book their initial contracts. That will result in a pullback or a surge of the demand of a particular currency pair in their pairing. So before we continue, to fully understand the institutional market maker method, you need to get the full course. We have a streamlined, straight to the point, which is going to for $99, and see more details via the link that I've left in the description box below, so that you may actually enhance your knowledge on this particular subject. So the next topic is the required EMAs. So if you follow this channel, you know our common EMAs. They are not there to help us predict the market, but to smoothen out how price moves. We use the EMA 5, 13, 50, 200, and 800. And I've seen a lot of comments, even after I defined the EMAs, someone would actually say, what is the EMAs? These EMAs are exponential moving averages applied to close. So it's period 5, 13, 50, 200, and 800. Then entry anticipation. This is the most important part of this video. We mentioned that from peaks, market makers are in drive. They have open contracts when we are coming from peaks. So when they book their initial positions or contracts, usually the market will pull back because of the reduced demand or supply of a particular currency. So after we come from a peak, right, the market makers will be in drive. They will be actually having open positions, and with that it will be shifting, or it will be actually increasing, in this case, the demand of the best currency, right? So after they close or book some of their positions, would see the market actually pulling back. So the 50 EMA is a base where we expect market rejection and trend continuation. So we expect to see a pullback that will be terminated at the 50 EMA, and then the market actually continues. So this doesn't matter on which time frame it occurs. It all depends if you are an intraday trader or a swing trader. If you're a swing trader, you may actually take these particular positions, the rejection trades, on the 50 EMA. So the golden trade setup is basically the 50 EMA rejection trade and trend continuation. These trades fail, if I can say, they are actually 90 to 95% accurate, if done properly. And it should be noted that the market will retest the 50 EMA several times, but the rightful times are from defined peaks. If you open your chart, you are definitely going to see the market retesting the 50 EMA several times, but it's not always that you need to respect. You only respect when we are coming from a valid peak. And what did I say? A valid peak is a peak that is a PFH or a PFL. And we determine those PFH and PFLs from counting of levels. So let's go over the charts to actually have an example of everything that we were talking about. All right, so in this case, we are on Euro against Japanese yen. I'm going to use the H1 time frame for illustration's sake, and on that, I'm just going to mark some levels. In this case, we can see we had level 1. Let me alter this. It was level 1, right, which was the first impulsive rise, the second impulsive rise, and some consolidation, and we had the last impulsive rise. So this was actually a peak formation high that was determined from the higher time frames. I haven't gone to the H4 and so forth, so this was a peak formation high from the higher time frames. So after determining that it is a peak formation high, the next thing is now for us to wait and see a peak locking, right? A peak locking is basically a 1350 EMA crossover, right? So in this case, a peak actually locked at this point. After locking, we were now looking for rejection of the 50 EMA. In my case, my 50 is the one in blue and my 13 is the one in red. So we can actually see that our rejection actually occurred at this point. We had price rejection of the 50 EMA at this point. Therefore, we had our first entry right there. So it's an entry that was going to be ended at the peak formation low. Therefore, we had a peak formation low at this point, right? So we have said the first thing is actually to validate the peaks by counting of levels. In this case, we had 1, 2, and 3, and we reached the peak formation low. A reset was actually given at this point. We had this reset. The next thing was now to look for a rejection on the 50 EMA. Unfortunately, I wouldn't want to have a rejection at this point. Of course, it was a perfect point of entry since it was a rejection of the 50 EMA after a peak had logged at this point. But in this case, we can see that we had level 1, level 2, and we were now actually in a zone of danger since it was now level 3, right? So in that case, we can safely say that this is a peak formation low. It's a valid peak formation low from the counting of levels. And as I said, we are not going to delve much into counting of levels. So we had 1, 2 correct trades, and now we are waiting. Since this is a peak formation low, we can actually say we are now expecting a buy, right? So from that, we had a peak lock, right? A peak lock with 1350 crossed at that point. Then from that, we had this. It was an attempted rejection. We could actually enter this point, or we could actually wait to see a proper 50 EMA rejection, which is this one, right? So it was a very good trade that actually played out very well. From there, we had a beautiful trade in the past week, which was this one. Why did we take this trade as a very beautiful one? It is because this was a valid, peak, right? So this is the point that I was saying. You can see this script above. It was actually there to take orders or to take the liquidity that was available in this zone before they shifted the markets. So that is why I was saying it's better off to take these positions. If you can see this small point that we have back tested, you can see that it was highly accurate. We had an entry point here, an entry point, and these entry points can be actually I would mark them like this below candle closure, below the 13 EMA, right? And another one, let me change this color so that it will be clearly visible. It was a buy, so I'll put a green line. So it was this line. So you had 1, 2, 3, 4 beautiful trades that you could actually take, and you were in the money. So you may try out this before you apply on real markets so that you'd see if it is actually conducive for you. On that note, we come to the end of this video. Check out our advanced course. I've left the link in the description box below. Welcome to lecture 5. In the previous lecture, we talked about resets and order blocks as well as order flow. In this lecture, we are going to be talking about the EMA simplification theory, which is basically exponential moving average theory. That is going to be using the indicators that we defined earlier on. So basically, what are moving averages? What are exponential moving averages? So exponential moving averages are basically indicators that plots the average of closing candles over a particular set period. So moving averages, when used in appropriate way, that is in the context of the market maker method, can give one, a true reading of the market direction, a reading of market momentum, entry and exit signals, moving support and resistance points, as well as targets for a take profit. So in this case, we are going to clarify more on using them as moving support and resistances. So the moving averages that we use and their color codes involves 5 types of indicators. These are the period 5, we usually put it in yellow on our charts, period 13 in red, period 50 in light blue, period 200 in white, and period 800 in dark blue. So the EMA simplification theory states that whenever a lower period EMA crosses a higher period EMA, price pulls back to the higher period EMA after the cycle has completed. So what do we mean by this? We defined levels in our previous lectures. After having 3 levels of drop like that, we usually have 2 EMAs crossing over above all other EMAs at this point, right? If we see this particular EMA crossover, we will expect to see the market coming back to the higher period EMA like that and probably issue a reset. So this holds in all time frames. If it happens on M15, we'll actually have a reset on the higher time frame like that. This concept forms the basis of resets, and as we defined resets, we said resets are cycle restarts and occurs at the 200, 800 or order block. So in this case, we usually have 50 and 200 EMA crossover after 3 levels have been completed. So with this case, we'll see the market actually following up to retest the higher period EMA like what the theory says. So an example of what we are saying if we see a 13 crossing a 50 EMA on the H1 time frame, we expect to see price come back to the 50 EMA. So usually this kind of crossover will occur after level 1 flow. So if we see a 1350 EMA crossing each other, we expect to see the price come back to the 50 and give us a bounce to continue with our flow. Then example 2 if we see a 200 crossing an 800 on the H4 time frame, we expect to see price to come back to the 800 EMA. So whenever we see two EMAs crossing over, we will actually anticipate to see the market coming back to retest those zones. However, someone might have a question that, what if we see a 50 EMA crossing an 800 EMA? Can we respect such kind of a crossover? No, that is the answer. We do not respect any crossover that skips any EMA. So 513 are valid, 1350 are valid, 50 200 are valid, 800 200 800 are valid, not 13 200 or 13 800. We do not skip any crossover in between those EMAs. So what we are basically trying to illustrate here is, after three levels of drop has been issued, level 1, level 2, and level 3, after the cycle has been completed, we expect to see the market to come back to the higher period like that. So still on that case, we would like to define another concept on how to count levels using EMAs. So we actually defined levels and said in one higher time frame level, we usually expect 3 lower time frame levels. So with that, if we see an H4 time frame moving like this is an H4 time frame going up, we would expect to see 3 levels on the H1 time frame, building one level of the H4 time frame like that. This point being this one, and this point being this one. And these are called resets, which are basically cycle restarts. So this is H1 time frame, and this is H4 time frame. So in this case, this becomes the first cycle, second cycle, and third cycle. In the first cycle of the market, we expect to see a 1350 EMA crossover for level 1, a 50 200 EMA crossover for level 2, and then a bounce of the market on the 13 or 50 for a level 3 floor. Then we have our reset on the 200 EMA. Then after that, we expect to see level 1 being given with a 1350 EMA crossover, then level 2 starting as a bounce on the 13 or 50 EMA, then level 3 starting also as a bounce on the 13 or 50 EMA. Then we have another reset on the 200 EMA again. Then from there, level 1 will always give us a 1350 EMA crossover. If you see yourself validating any level 1 without a 1350 EMA crossover, you are probably doing something wrong. Then level 2 will initiate as a bounce on the 50 EMA or 13 EMA, as well as level 3 like that. So basically, that is how it goes with counting levels using EMAs. I will illustrate that on the charts. So let's go over the charts to see how this is done. So this is USD against CAD. We are not going to go back to the higher time frames like the H1 and so forth, but we are going to just start at this point. So in this case, we are going to count levels from this low on this H1 time frame, and we have defined that we expect to see the market giving us should give us a 1350. In this case, my 13 is in red, my 50 in blue for level 1. So we had a level 1 flow. After that level 1 flow, we had level 2 flow where we had a 50-200 EMA crossover during this level 2 flow. Then we had the last level as a bounce on the 13 in red that came up like that. So we had 3 levels of rise. Then the next thing was to have a reset, and the reset occurred on the 200 EMA. Why? Because the EMA theory states that whenever a cycle is completed and there is a crossover, the market approaches the higher time frame, the higher period EMA. So in this case, it actually coincided as well with the order block that was issued at this zone. This order block, which is the last red candle that was issued at this point, and the market resetted. Then after that, this became cycle 2. And in cycle 2, we have said the market will actually give us a 1350 EMA crossover for level 1, which is this one, then a bounce on the 50 EMA, and then a bounce on the 50 or 13 EMA. So in this case, we had level 1 and then level 2, which actually gave us a bounce on the 50 EMA, and then level 3. We reached another peak, and from there, what do we expect? A reset, since we still don't have a completed cycle. Then the reset, where did it occur? We can see now that there was now a 200 800 EMA crossover that was issued at this point. So what happened? This now was manipulation, but as you can see, they were pinning the same point. So what do we have right now on USD CAD? The next thing that we can see is we can see a 1350 EMA crossover, implying that we are still in level 1 and we are expecting a pullback and then a continuation going up. So probably this kind of rise is actually a news-driven rise. Right now, there is geopolitical uncertainties that are going on, Russia against Ukraine attacks. So we would actually wait to see what will happen in the markets. So that was the first example on how to use EMAs in our trading. Then another example is on Euro against CHF. In this case, we are going to count levels using these EMAs as well. So the first thing that we can see is we had a flow where we had a 1350 EMA crossover. Then another flow whereby a 250 EMA crossed over during that particular impulsive drop, like that. Then we had the last drop at this zone, which actually started as a bounce on the 13 EMA in this case. So level 1, level 2, level 3. What are we now expecting after 3 levels of drop? A reset. Where do we expect a reset? 800, 200, or order block. In this case, a setup was issued on the 200 EMA, meaning that this was a valid reset. Then after that reset, level 1 should always give us a 1350 EMA crossover like this. So what happened later? We can see some consolidation like that. Then after that, the market bounced on the 50 EMA to show us initiation of level 2, since it's now a second cycle, right? This is now a second cycle. Then what happened next? The market bounced on the 50 EMA again to give us a very long level 3 like that, right? What's next? The market gave us a reset. Right now, it actually did the reset at the order block, right, which is the last green candle before this shift. So the market actually came back to retest that order block as well as the higher period EMA, which is the 200 EMA. And in this case, we can see that 800 and 200 are actually crossing. So with that in mind, if we go on the H4 time frame, we can see that what can we see from, actually let's go back to the H1 time frame. We can see that so far we have been issued level 1 flow, right, which actually originated from that zone going down, right? So we don't know yet, but this bounce is actually a sign that probably we are now starting level 2, like that. So if we go on the H4 time frame, we can see that the market has given us 1 H4 level, 2 H4 level, 3 H4 level, and after 3 levels we would say the market has completed the H4 cycle, and we are now expecting to see it pull back to the higher period EMA. In this case, the 200 EMA would have flowed probably, it would have flowed probably to these zones. It will be around these zones. So after completion of the cycle, we would see the H4 time frame giving us a reset and continue like that. So that was it with the EMA simplification. You need to practice as well to actually understand it. As always, practice makes perfect, and do not hesitate to ask questions if you have any. So in our next lecture, we are going to be talking about the sacred market pattern, the 2 types of trades, the entry criteria, and the entry confirmations and exits. Thank you. See you on the next one.